Hello everybody and welcome to this, the slightly belated financial planning update for May 2022, recording this video on the 7th of June, just following the bank holiday weekend. We'll begin as we usually do with a market update, and we'll start off just by looking at the market's performance in general. And we see here a developing theme now, which is that the FTSE 100 UK market significantly outperforming both the US and global stock markets. And that's a reflection really of the FTSE's more conservative nature when compared to the US in particular, but of course the US has a very significant impact on the global markets as well. And we see in fact the world index almost in lockstep really with the S&P 500 in the USA. The FTSE, however, is the real good news story here, and this is a welcome change to what has been the status quo for many, many years now, really, which saw the FTSE really as the laggard. So it's pleasing to see the UK market having its heyday, and the divergence, that the delta between the two has actually increased quite substantially during the month of May. So we really see the UK market as the standout performer. And that's driven mainly by the fact that the UK market contains far more conservative and cautious businesses. In terms of portfolio performance, we've really seen a slight fall during the month of May, followed by a recovery. So we end the month in a reasonably similar position. Although what is notable, you'll see, is that the portfolios have taken their rightful place, if you like, and we see now that the adventurous portfolio is now the best performing portfolio year to date, albeit registering a loss, followed by the balanced and then the cautious portfolios. And that's very much in line with expectation. When markets are falling, however, very often that position is reversed. So if you cast your eye back to the March to April period, you'll see that there was a time where the adventurous portfolio was actually the worst performing, but that position has now reversed itself as we've started to see some gentle recovery in markets, and so the portfolios are now taking their rightful place. Considering markets in the US are off by upwards of 20% in dollar terms in some cases year to date, then these performances actually don't look quite so bad in that context. Comparing the passive and the active portfolios, we'll notice a slightly larger than usual divergence here. It's often the case that the two portfolios behave very, very similarly. However, we have seen the passive portfolio outperform during this downward market, which is really just a reflection of the fact that it is tracking the broad indices, which have done very well. Of course, different sectors have behaved very differently, suggesting that active managers may not have picked quite so wisely during this latest downturn. Now, what's also interesting is that we do see volatility starting to calm down. This is the VIX Volatility Index, which just measures the volatility within markets. Now, the volatility index has been slightly elevated really throughout the whole of 2022 thus far, but we have seen things start to calm down, certainly towards the latter end of the month of May. Things have certainly been a lot calmer on markets, and we're not seeing those 2, 3, 4% swings on a day-to-day basis that we were perhaps earlier in the year. And although this volatility is still somewhat higher than average, if we take a slightly longer term view, we put this in the context of a 3-year picture here, we can see that compared to the COVID period, that the volatility we're experiencing now barely registers on the scale. So as with all things, although they feel quite significant at the time, when we put them into context, they're perhaps not quite as serious as perhaps we thought they were. Now, portfolios have benefited during this period from two things really. Of course, because we are UK investors, we tend to have a slight overweight to UK assets, and that's been a really good thing during 2022 thus far. The other thing to mention is that we are still very underweight UK government bonds in all of the portfolios, and even where we are holding bonds, we tend to prefer what are called shorter duration bonds, which means that they tend to be less sensitive to interest rate increases. So again, that has helped the portfolios just hold their ground really during what's been a pretty difficult start to the year. Moving on to global themes, of course, we have two familiar suspects here. The conflict with Ukraine and Russia continues. I think the market has largely got its head around what's happening now, and as always with these sorts of crises, the market has now rationalised what's going on. And of course, models and assumptions have been adjusted now to take account of what's happening. It doesn't take away, of course, from the human cost of the crisis, but from a market perspective, markets will tend to adapt quite quickly to these things. And of course, expectations change. And I always say markets don't tend to react to changes in reality, they react to changes in expectations. So that the market as a whole will now have an anticipated path, if you like, for the conflict. And I think it's reasonable to assume that the conflict is going to be slightly longer term, perhaps than people thought a few months ago. And that's now sort of priced in to a significant extent. So it's only a significant change, either for better or for worse, in the path of the conflict that's now likely to move markets in a significant way. We've seen China just start to release some of its hard lockdowns in the last few weeks, and that will only be a good thing for markets in the slightly longer term. China will have, no doubt, significant bottlenecks that need clearing. You may have seen some of the graphics going around that show all of the ships floating around in the sea off China because they haven't had the capacity to dock them. So there will undoubtedly be backlogs of goods and finished products, if you like, that need shipping in and out of China. But it is pleasing to see that at least lockdowns are starting to ease, and that should begin to unclog some of the supply chains that clearly have been quite blocked up since the beginning of the year. And of course, last night we had the, no surprises really, but we had the vote of confidence in Boris Johnson's leadership. Of course, he did win the vote of confidence, however, not by a huge margin. So this will start to call into question, how long perhaps Boris has left as Prime Minister and whether there will be a resignation. Perhaps that's unlikely, but he may be forced to step down at some point in the future, as happened, of course, to his predecessor. So I think it's fair to say that Boris is probably slightly wounded by last night's events, and it might just soften some of his policy stances. So we might see perhaps a slightly more moderate policy direction moving forward, although it's too early to say really what that means long term for our financial planning and tax legislation. Now finally for today, we're going to return to our series of advanced financial planning ideas, and today I'm going to explore the ability to either offset or indeed eliminate capital gains tax liabilities by reinvesting into an enterprise investment scheme or a seed enterprise investment scheme. So just to set the scene here, let's imagine that we've just sold a buy-to-let property and we have generated a £100,000 capital gain. Now, just to keep things straightforward, I'm going to ignore the annual exemption for the moment. We're going to assume that we have a higher rate taxpayer and therefore they will pay 28% capital gains tax on the 100,000, which means we have now a £28,000 tax liability to deal with. Now, of course, as is always the case, an option that is available is simply to pay the tax, and that's the end of it. And for many people, that will be appropriate. However, if we would like to plan around the tax liability and think about how it could be mitigated, then an EIS can be an attractive option. So one option would be to reinvest the gain into an EIS, an enterprise investment scheme. Now, just to set the scene again, EISs are most certainly at the higher risk end of the investment spectrum. We are dealing with smaller and generally unlisted companies, and therefore these investments tend to be fairly, if not completely, illiquid. So we need to be prepared for all of that. But to compensate for those things, the government offers fairly generous tax reliefs. And one of those, with an EIS, is capital gains tax deferral. So if I take my gain and invest it into an EIS, the gain is then deferred. So what that means in practice is that I don't have to pay the tax bill right now. Now, one option is that you can theoretically defer the gain indefinitely. If I keep holding that EIS investment, or alternatively, if I keep rolling it over, even if one of the EISs matures and I invest into a further one, I can keep deferring the gain until the point where I pass away. And when somebody passes away, capital gains are extinguished. So it is theoretically possible to defer the gain to the point where it actually gets eliminated later on. Alternatively, the gain would be deferred until such time as the EIS investment is sold. So it's a good way potentially of kicking the can down the road. Now, in addition, EISs come with a 30% income tax relief, and after a 2-year holding period, a 40% inheritance tax relief as well. So when you stack all of that up, we actually end up with the vast majority of the initial investment being returned in the form of a tax deferral or outright tax relief. Now, taking it one step further, we could also think about investing the gain into a seed enterprise investment scheme, an SEIS. And here we're investing in even smaller and less liquid companies. We really are talking about startup companies here. Now, with an SEIS, half of your capital gains tax is actually written off. So we would eliminate half of the CGT bill, never to be seen again. With an SEIS, we get a 50% income tax relief and also a 40% inheritance tax relief after a 2-year holding period. So by my calculation, that potentially means we have 104% of tax relief available for a higher rate taxpayer, which clearly makes that a somewhat less risky proposition than it might seem on the surface. Now, these are fairly complex investment vehicles. They're investing, as I've said, in smaller and less liquid companies. So it's certainly the case that these are not going to be right for everybody. If you would like to understand more about these planning ideas, I'd strongly suggest you tune in to our Inheritance Tax Efficient Investing webinar, where we go into both of these concepts in a lot more detail. For the moment, I will just mention that none of that is designed to constitute specific or individual advice, and if you would like to explore how these things might be applicable in your own circumstances, then please get in touch with a member of the team and we'd be happy to have that conversation with you on a one-on-one basis. That's everything for the financial planning update for today. We hope you found it beneficial, and of course, if you do need anything in relation to your own financial planning, please don't hesitate to contact a member of the Buckingham Gate team.